As much as the market is worried about the prospect of no-deal Brexit, we think this tail risk has already been priced accordingly, leaving the pound in a much better position to outperform over the medium to longer term. We view any talk of no-deal Brexit in March as nothing more than political posturing and leveraging in an effort to bring the EU back to the negotiating table. A no-deal outcome in March would not only pose severe downside risk to the UK and EU economies, but would also pose systemic risk to the global economy at a time when such risk can be ill-afforded given already exhausted government and central bank stimulus tools in the aftermath of the 2008 crisis. If Theresa May is unsuccessful in the days ahead, we believe the more likely outcome will be one which has the can kicked down the road in the form of an extension to the Article 50 trigger date. This is an outcome that sheds better light on the outlook for the pound as well, as it gives the market confidence that a resolution will eventually be worked out, putting the focus back on traditional fundamentals that have already been arguing in favor of a recovery in the currency. Technically speaking, we've already seen the cable rate push back into an official uptrend on the daily chart as per the Ichimoku indicator. We've introduced the idea of a longer-term higher low off the plus 30-year post-EU referendum low that was seen in 2016 ahead of the next major upside extension within what could be a developing longer-term uptrend. The September peak at 133 is a critical resistance level that, if broken, would do a good job supporting this view. As far as the downside goes, we recognize the market could still be inclined to chop around with all of this uncertainty and would suggest that any setbacks from here should now be very well supported, ideally around the 128 area, though only a breakdown back below the early January low would truly compromise this outlook. That low is in the 124s. That's all for now.